Thanks everybody for joining. Especially those people on the East Coast. I know it's getting late for you, but I think in the next meetup, we'll actually try to make it a little bit earlier, maybe 6 o'clock, 6:30. I think that'll also be pretty convenient for people. So, but for today, yeah, let's go ahead. So today's topic is an introduction to apartments, right? So, we usually have meetups about once a week or so. Once a month or so. Usually when I'm less lazy, I'll have them more often. And, we gotten a lot of new members in our meetup. So I thought it would be a good idea for us to do a quick introduction to apartments and, why do people invest with them? How do they compare? What are the structures, etc. So I'd love to make this interactive. So if you guys have any questions along the way, please feel free to just either, ask or just send it through the chat. Okay. So cool. Standard disclaimers. We're not real estate agents. We're not brokers. And we're not attorneys. So everything that we're saying here is really just for educational purpose. It is my belief that the more people know and the better people are educated, everybody's able to make a better decision for themselves in terms of like, what is a good investment? What, are these people reliable, etc. So, educational purposes, don't sue us. The best way to get more information, also to be notified of future deals, please feel free to join our mailing list. So I've been kind of slacking on that, but I do plan to also start sending more like a monthly or bi-monthly update on just how things are going. We're also constantly looking for new apartment deals. And we'll only publish the upcoming deals to the people on the mailing list. We won't be it won't be a public broadcast. So if you're interested in getting new information, please feel free to sign up for our mailing list. Okay, so I'm just going to also put this in chat in case you guys want to be able to contact us. Alrighty then. So a little bit about our agenda for today. So today we'll do a quick team introduction about who we are, and also we'll start going down starting from what people are most familiar with to diving into a little bit more detail about like how does apartment work and everything. So we'll talk about how the single family rentals compare with multifamily apartments. We'll talk about what a syndication is, why do people, a lot of people invest in syndications. And we'll also talk about, how are these apartments valued, right? It's a business, it's a little bit different than single family. So how do you determine the value of these apartments, okay? And finally, I'll talk a little bit about the current market conditions. What am I seeing? So like I was mentioning before, I took a recent trip to Texas to check out the markets there. And basically, what is the current dynamic, right? What is the pricing like? I'll talk a little bit about that as well. Cool. So a little bit about who we are. So we are a team of out-of-state investors. We have, our primary focus is on buying stabilized apartments. Okay, so we usually look for Class B or C+ type of property. We're looking for anything I would say 120 to 200, 300 units in size. Okay, so we look for a fairly good size apartments. So far we have acquired about $35 million worth of assets, in total about 350 units. And we raised over $6 million in funding. For example, this is one of the groups that invested in our previous deal. So it's always a group of people that band together and we're able to buy much larger assets than any one of us can buy by ourselves. So in addition to the people who have already invested with us, we also, we're basically a large investment club with, that share information and talk about our experiences, right? So we have, with this meetup, with other Facebook group, etc. We have well over 500 people in our investment community. And yeah, so that's the pool of people that when there are deals, people get together and get together and invest in deals. And we like parties, so local here in the Bay Area, during Christmas, whenever we have a deal announcement, we try to find excuses for parties. So when we have a new deal, when the deal closes, Christmas, etc. So we'll always find an excuse to celebrate. So a little bit about the team. So I'm Tony. My background is in software. So I've been doing software for over 20 years. Right now, primarily focused on cloud computing. And it's still a job that I'm passionate about. I just love building things. And also I enjoy working with numbers. So that lends pretty well to the investing side of things, because I tend to overanalyze things and make sure all the projections and everything actually works out. So I favor small companies. I really like the small company aspects. So typically I join startups, pre-IPO startups, and I was lucky that 2 of them actually went IPO. So usually when we hit about 800 people in size, I transition to a new startup. I really enjoy, getting my hands, right on the product, and whatever I do may be the death of the company tomorrow, but at least I'll be part of it. Okay, so, and I'm also super involved in real estate. I really enjoy it. But out of all the real estate investment types that I've been involved in, I really like the apartment, the apartment way of investing, right? Scaling up. And I'll go into that a little bit more detail. So, I sponsored and, also was key principal on 3 large apartment complexes. So these are basically 100 to, 280 units in size. But before becoming an active sponsor, I started off by passively investing into other deals. So all in all, I have invested in about 12 deals. And I invest in a variety of things. I invest in self-storage. I invest in new construction. I invest in, commercial retail. Also, apartments alone, I have invested in 10 different apartment investments. So passively, I'm in about over 3,000 units. So yeah, I had quite a bit of experience before becoming active. And my partner, Dave Lin, he also has a lot of experience investing in multifamily syndications. In addition, we call him Mayor Lin because he has a few rental properties here in the Bay Area. He also has a few quadplexes in Austin that he bought a few years ago. So, he's also diversified. He has commercial hotels in China. He also funds startups. So, Dave gets around. So, anytime that we do these type of investments, it's never a single person, right? It's always a team of partners, okay? And in reality, you never really want to invest in a deal where there's only one person doing it. Like, God forbid he gets run over by a truck or something like that, then you have nobody managing it. Or sometimes, one of the partners may need to go on vacation, etc., right? So it's always a team sport. So on the previous deals that we have acquired, we partnered with, we have Dallas partners that are boots on the ground. So even though that I live in California, my partner, lives in California, we don't invest in California. We invest in out of state, like Texas and other places that we can get a much better return and much more landlord friendly locations. So, but to do that, you want to make sure that you have partners who live in the area, who is your boots on the ground and can coordinate, right? So, so Ken and Win is our partners. They're super experienced. So Ken and Win are over here. They started off by buying single family homes. So, from about 2012 to 2016, they bought over 70 single family homes in the Dallas-Fort Worth area. Okay, and Win was pretty much managing everything herself. So very, very busy. That's a lot of tax forms. That's a lot of maintenance calls. That is a lot of things to do, right? So they decided that instead of trying to manage 70 plus single family homes, why don't I manage one 100 unit apartment, right? That's much more efficient of the use of their time. And you get even better return than if you were trying to manage all the single family homes yourself. Okay. So that kind of leads us into the topic, So I think a lot of us already have familiarity with single family homes. It's the most accessible, it's most, what we're most used to. Okay. And a lot of people, including myself, like to buy homes and rent them out and look for the future appreciation, right? So there's a lot of pros and cons to having single family versus a multifamily. So multifamily in this sense is defined as anything with 5 units or above. Okay, so anything 5 units or above is considered to be commercial multifamily. Anything from 1 to 4 units is considered residential. So like a duplex or a fourplex are considered to be residential. They would get residential loans, whereas anything 5 units or above, you would basically get commercial level loans. Okay, so all the way up to 400,000 units, etc., will all be commercial loans. So what are the pros and cons of single family, right? So I think one of the best pro for single family is, you are the owner, you get full control, you get full say in everything that goes on, right? You choose the tenants, you decide how much rent it is, you can touch a property, it's yours, it's under your name, all that kind of stuff, right? So a lot of people really like that, right? And the second thing is it's also very easy to liquidate, right? So, if there's a need or if you want to time the market, you can sell the house anytime you want. Maybe, as long as the tenant is willing to move out. Okay, another pro is you can borrow against any equity that has built up over the years on the property, right? So a lot of people do what's called a BRRR strategy, where you buy, you renovate, you rent it out, and then you can refinance the money out to go buy even more, right? So that's also one way people go from single family to multiple units like a fourplex, in order maybe getting into a small multifamily like a 16 unit, then to a 40 unit, then to a 80 unit, so on and so forth, right? So that's usually the path that people take. So what are the cons of holding a single family? Well, it's a double-edged sword, right? It's full control. you now need to handle everything about the single family, right? So, it's almost, for some people, it's almost like a full-time job, right? If you're managing, 2 to 3 units, you're worried about like, oh, how's the rent going? Oh my God, this is empty. Oh my God, the tenant is not paying me, etc., etc., right? So you own all the responsibilities as well, right? Okay. Another thing is, because it's a single unit, so you can't really afford to have a on-site staff that takes care of these things for you, okay? Which means that, hey, if there is a toilet, the toilet is stopped, right? It's a plumber call, and the plumber may charge you $100, $150 just to come out and take care of that one stoppage, right? It just basically doesn't scale, right? And also, if you're doing renovation, if you're doing, a lot of times when you're getting pricing on things that you want to do with the property, you don't benefit from like the true bulk pricing, okay? For example, when we renovate an apartment, we may need to replace all the refrigerators in there, right? So we're buying 200 refrigerators. So as you can imagine, the pricing that we get on 200 refrigerators is a lot cheaper than somebody just buying 1 or 2 from Sears or something, right? So the renovation cost in a large apartment, when you're doing 100, 200, and there's other apartments in your metroplex that's also doing renovations, and we all buy materials together, that really, really brings down the cost of things. And finally, I think this is also one of my major concerns. So if you have a single rental house, right, and for whatever reason the tenant stops paying because of COVID, or if he moves out, right? So it's an all or nothing type of thing. Okay, so you're getting great rents, and all of a sudden it's like zero rent, right? If he vacates or if he stops paying, you went from having full payment to nothing, okay? And it's a pretty dramatic hit. That doesn't really happen with apartments, because so typically, like, let's just say on a 100 unit apartment or 200 unit apartment, if you have 10 people move out, let's say if you have 10 people move out on a 200 unit, you only lost 5% of your income. Okay, having that larger scale smooths out these kind of ups and downs, right? And it makes these kind of people moving out, people not paying, is normalized, and it is actually makes it a lot more resilient, right? So I can lose 10, 20 residents, and I'm still collecting 90% of my income. So it doesn't have big up and downs, right? So it's another function of scale. Okay. So hence the question, why invest in apartments? So when I first started to look at where I should put my spare cash, right? So I actually went to a ton of meetups, which I also recommend that you guys do, right? There's, for example, right now in the San Francisco Bay Area, there's like 30 to 40 different groups on, different type of investments, right? There are people doing flips, there are people doing Airbnb, people doing code knocking, land notes, self-storage, marijuana, you name it, right? There's people literally doing anything that you can imagine, right? So before I started to think about what to invest in, I actually went around and checked out all of these meetups and compared them, right? And I think everybody's criteria is going to be a little bit different. For me, I had 2 main criteria that I wanted to hit. One is I want to make sure my investment is downturn resistant, okay? So if we have a crash, right? If we have like another 07, 08, or if we have something like a COVID, I want to make sure that my money is saved. Okay, it's safe, and it won't just dramatically lose value because of the economy is bad. Okay, and and second thing is I wanted to have tax benefits. Okay, so as a as everybody who earns a W-2 income, that you're getting almost no write-offs. Okay, especially with the latest tax laws, right? You're getting completely screwed on your ordinary income. So I was looking for ways to earn income while still being able to be very efficient on tax. Okay. So originally, I know that investing in California just doesn't work. Over here, if you buy like an $800,000 home, you'll be lucky if you can rent it out for $3,000 and $4,000, right? That's like 0.5% of your purchase price in monthly rent. Okay, we typically want to see 1%. Okay, so you can get that in Dallas, okay, in Texas. So I actually went over to Texas quite a few years ago. I was planning to buy a bunch of single family homes. At that time, you can buy single family home for about 100 to 1,100,000. Okay, only about $100,000 per unit, and you can rent them out for $1,000, hitting that 1%. Okay, you just can't get that in the Bay Area, right? So instead of buying one $800,000 home, I could go to Texas and buy 8 $100,000 homes, right? And I will be cash flowing maybe $200, $300 per door, right? So that would have been a much nicer income. But at that time, that's when I met Ken and Wind, and I started to understand that, hey, they're actually investing in apartments instead, right? Investing in 200 units, 300 units, instead of trying to buy and manage each one of them separately. So the nice thing about apartments is you can invest in much larger scale apartments, much nicer properties, right? Basically investing in what used to be exclusive privilege of these institutionalized people, right? The second thing is very downturn resistant. Okay, I'll go over these in more details later, but basically, as we saw during COVID and all that kind of stuff, when the economy gets rough, people are forced out of their homes, or they can't afford the very expensive apartments, and they move to the Class B and Class C apartments, right? So during a downturn, apartments are actually very, very full. So for example, one of the property that I manage, the past 2-3 months is actually, we're at 98 to 100% occupancy. All throughout the whole COVID time, across the portfolio that I have invested in, I don't think that any property really dropped below 90% occupancy. They're all at least 90% occupancy, and they're able to collect majority of the money, right? So I'm talking about like 90% more of collections. So that's a nice thing, right? Because people always need a place to live. They're willing to sell their car. They're willing to get rid of, not buy gifts, but they need to pay for the place to live. And that's why there's such a demand for apartments, because it's so downturn resistant. Economy of scale, we talked about. I'll show examples of that. You also get tremendous tax breaks when you invest in apartments. One of the bills that Trump has passed was any investments in these large real estate deals involving a flow-through entity, such as LLC, the profits that you make, 20% of that doesn't get taxed. So that's tremendous benefit. And then since we hold on to these apartments for many years before we sell, these are all the appreciation's long-term capital gain. And then for the first few years, because we're able to take bonus depreciation, so the cash flow that you get for the first few years on these properties, the cash flow that you get is all, you don't have to pay tax on them. They're all tax deferred, right? So with that extra money, you're able to do other investments and make your overall return even higher. So it's very, very tax efficient. That's what I love about it. Okay. And also, in terms of like the overall returns, it's one thing to remember is apartment is run like a business. So residential tends to kind of go up and down with the market. If your neighbor sells for less, your apartment your valuation goes down. But apartments are businesses. That's the best way to think of them. They're businesses. Their value is based on how profitable they are. So the next buyer that comes to buy your apartment, they're buying your profitability. Okay, so the more profitable you are, then the more value your apartment is. I'll give an example of that later as well. Okay. And finally, the loans on these apartments are just great. Okay, so we usually get our loans directly from Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac, these federal agencies actually have two divisions. They have a residential division and they have a commercial division. And the apartment, so commercial, they loan to everything, right? It could be retail, it could be construction, it could be industrial, it could be retail, right? Out of all these different segments, apartments have been the most stable one. Okay, so while they will only lend up to maybe 60%, okay, or maybe 70% in those other type of segments, for apartments, they're willing to lend up to 80%. Okay, they feel very safe about the type of returns that they will get. And right now the rates are like mid 3%. So you can go to Fannie Mae and say, hey, Mr. Fannie, I want to borrow $60 million. Okay, what can you give me? And they'll say, okay, here you go. I'll give you $60 million at 3.5% rate. And I'll give you a few years of interest only. Plus, if the value ever falls below the loan, I won't come after you for the difference. Right? I mean, that's like super, super nice. That's called non-recourse loan. So, and Fannie Mae and Freddie Mac, they're willing to do this because in the history of them lending to apartments, it's always been so stable. So yeah, that's why we're able to get that type of financing. I'll stop real quick. Any questions so far? Okay.
One question.
Sure.
What kind of cap rate do you all expect? Like, San Francisco and LA is like a 4% cap.
Yeah.
We get like an 8% cap. What do you normally get?
So for those people who are not familiar, cap rate is a way that we kind of evaluate how expensive a deal is, for example. Okay, it's a relationship between how much net income, okay, net operating income a property has versus the purchase price. Okay, so how much are you paying for a certain amount of profitability? You can kind of think of it that way. So a higher a cap rate, that means a cheaper something is. Okay, a lower cap rate means something's really expensive. So cap rate is basically net operating income divided by the purchase price. Okay. So right now in Texas, I actually have a slide on that. So you can kind of see for Class A type of property, these are the really new fancy ones, less than 10 years old. I have here as 4%, but it's more like 3.5% in Texas right now. Okay, in the major metros. For Class B, we're seeing about 4.5 to 4.25 cap rate. Okay, and for Class C, it's probably at about a 5 cap right now in Dallas, right? So that's going to be more expensive in cities like Austin. So some of the Class Bs I looked at in Austin, it's probably trading at like a 3 cap. okay, versus a 4% cap rate in Dallas. So Dallas is a lot cheaper compared to Austin, even though the properties may be making the same amount of income, right? So in Austin, things are more expensive because people are betting on the fact that I'm getting lower return, but the appreciation will be higher in the long run, right? So that's a kind of cap rate that we're seeing. It is a lot more compressed. So this slide is probably from a year ago, a year and a half ago. So you can see the cap rate has come down, right? Has come down. So this used to be a 5 cap. It's gotten much more expensive. It's 4.5 cap, 4.5 cap now, right? This used to be 6 cap. Now it's like a 5 cap, right? And part of the reason why things have gotten more expensive is also a large metro like Dallas is very different than how it was 3-4 years ago. There's a lot more people moving in. There's a lot more demand for housing to justify, why it is a more stable area to invest in. Okay, cool. Oh, by the way, this single family, this house is actually in the DFW suburb called Irving. So you can get a really nice house like that for $300,000. So that's really good. I mean, I think $300,000 in the Bay Area, you can barely buy a bathroom. Yeah.
我不知道要讲多少，这是第一次我参加这个东西。
Yeah, 这个大概 yeah. Sorry, I'm gonna speak in Chinese a little bit.
然后我可能今天早点睡。
Yeah, so
这
yeah,
个以后
35万左右。
这可能要不了1个小时吧。
嗯。
现在要。
Okay.
这
All right. Okay, I'm gonna move on. So sounds good, sounds better than a single family, but how do we buy something like this, right? So even me myself, I don't have $20 million to go buy a 200-unit apartment. Okay, none of us do. So how do we actually participate and be able to buy these type of apartments? So the way that we purchase these properties is through something called a syndication. So a syndication is a SEC regulated entity, okay? It's a SEC regulated either a 506B or a 506C entity, okay? For the ability for people to team up together and buy properties together. So this is not a new concept. I mean, just about every large property that you see out there is purchased by a group of people, right? Even institutional funds. Institutional funds are really, once again, a group of people with their money together to buy large assets, okay? So, anything you can think of that, that takes a large amount of investments is pretty much through either a syndication or some kind of large partnership, right? So startup investments, those investment funds are, once again, all groups of people, right? So a syndication is a group of investors pulling the money together to buy a larger, higher quality asset, okay? So it allows us, small investors like us, by only putting in maybe $50,000 to $100,000, you can participate in a deal to buy a 100-unit apartment or 200-unit apartment, right? So you'll probably see in these pictures, these are basically the closing parties when we buy an apartment. So syndications range from anywhere from like 30, 40 people to 80 people, and sometimes it grows even larger than that, right? But typically, yeah, I would say about 40 to 80 people easily. Everybody chip in a little bit and take their share of the profit as a business is running and when the business sells. Okay, so because these are SEC regulated entities, there are strict requirements on what they can and cannot do. So most syndications run as a 506B, okay, which means that they cannot advertise. When there's a deal, you cannot advertise to just anybody. You can only tell people that have shown an interest, okay, that are acquaintances of yours, okay. So most of my deals are 506B, which is why I say that if you're interested in joining our investment club and be notified when there's deals, we only send it out to our email list of people. We don't advertise that there's a deal coming. Okay. So 506C, on the other hand, can take as many people as they want, and they can advertise, but the requirement then is the people that invest in this deal must all be accredited. So accredited basically means your net worth must be at least, you and your wife net worth must be at least $1 million, excluding your primary residence, okay? So this is like a sanity test for SEC, so they don't want you to advertise to just grandpa, grandma who don't know what's going on, and you might scam their money telling them that, hey, we're gonna triple your money if you put in. They don't want that. Okay, so they assume that people who have already earned up to $1 million are financially savvy enough to know what they're doing. So that's kind of like the small litmus test. Okay, but most syndications are not that big, so we're pretty good with a 506B type of structure, and we don't really advertise. We typically have enough investors for the deals that we want to pursue, and we usually get funded very quickly, so it's not a problem. So each member of the syndication are part owner of the LLC for the asset, okay? Every time we buy an apartment, we create an LLC for it to protect the members from being sued, okay? And that kind of things, right? The LLC owns the apartment, and each investor is an owner of the LLC, okay? And thus represents your share of the profit in the apartment. Okay, so syndication consists of active sponsors and passive partners, okay? So out of this, you'll have maybe 2 to 3 people that is leading the deal, that is taking care of the everyday operation, that's basically taking care of the entire deal from beginning to end. And then there are passive investors, right, who just contribute the investment to the deal. And that's how I started. That's what I enjoy, because I find a syndication that I trust. I invest $50,000, $100,000 with them, and they are responsible for executing the whole business plan, right? Meanwhile, I can continue to do what I do best, do my programming, do my day job, right? I don't have to be bothered with running the thing at all, right? Somebody's taking care of it. So that's why I was able to do 10, 12 passive investments while still doing, my everyday regular job, right? I'm not impacted. So that's a very nice aspect of it. Okay. So, a little bit of acronyms. So syndication, LLC members, what are the 2 types? So there are the active partners, okay, and then there are the passive partners, okay. So as I mentioned, the active partners basically take care of everything from beginning to the end, right? So think of them, there was a pretty good analogy. Think of the deal as a plane, right? So the active partners are the pilots that's piloting the plane to the destination, okay? And the passive partners, they buy the ticket and then they're along for the ride, and they trust, and they're putting their trust in the active partner to know what they're doing, okay, to be able to execute the plan to get to the destination. Okay, So active partners are also known as deal sponsors. They're known as leads. They're known as asset managers. They're known as principals, and also as general partners. Okay, so you'll hear these words being used interchangeably. A lot of people get confused, but so yeah, active partners are most commonly called deal sponsors. Okay, in our circle, it's most commonly called deal sponsors, leads, or general partners. Okay, so passive partners are also just known as a limited partner. Okay, so in an LLC structure, there are general partners and limited partners. Okay, and I'll explain that a little bit more. So what do active managers do? Well, they're responsible for going out and to find and also evaluate which deals are good for the syndication to invest in. Okay, so this could take anywhere from a few months to a few years, okay, to find a deal that actually makes sense. Okay, the reputation is everything to the active manager, because if they're not able to execute the business plan and then doesn't do well, then nobody wants to invest with them in the future, right? So most active managers are very careful in evaluating deals, making sure that they can deliver on what they project. Okay, so once they find a deal that they think is good, the active manager will actually put it under contract first. Okay, and right now in this market, to purchase a property, you need to put down what's called a non-refundable earnest money, okay, that guarantees that you're going to buy the deal. So, in previous deals, we put in maybe $400,000 to $500,000 of our own money as a non-refundable guarantee that we're going to close on the deal. Okay, if for whatever reason that we can't close the deal because not enough people want to invest with us, or if there's other issues, guess what? We lose that $400,000 to $500,000. Okay, not the investors, not the passive investor money, our own money. So that's why we only buy deals that we have confidence in, and we know that we have enough people that will invest with us that will be able to close on the deal. Okay, so that's a huge barrier. So the active managers are also responsible for the loan. They're liable for the loan that we get. So if we go and take out a $10 million loan, if this loan defaults due to bad actor or whatever, it's the active manager that bear the liability. Okay, not the passives. The passive don't have to be part of this. Okay, so active manager had to find the investors, close the deal, set up the management team on the new property, and proceed to manage it for the life of the deal. Okay, so we typically project that we'll hold our deal for 5 years, maybe 7 years. Okay, so the active manager is responsible for operating this property for the entire duration of the investment. Okay, so that's where active manager actually spends the majority of their time, operating the property. Okay, also responsible for doing the quarterly cash flow or monthly cash flow distribution, calculate the tax, give the K1s to the partners, handle any property tax protest. You handle everything basically. So, there's other people that ask me, how do I become an active manager? The first thing I tell them is like, you have to like pain. Okay, you have to have, I kind of like pain, but it's worth it. I enjoy it. I like pain. So, and finally, the active managers are responsible for, a cash out refinance if there's an opportunity, or, selling the property, right? So beginning all the way to the end. So what do passive investors do? Well, every time there's a deal that comes in, you will take a chance. You would take the time to evaluate the deal. Is this a type of asset that you want to invest in? is this a sponsorship team that you trust, that you want to invest? Do the numbers look good? Okay, so passive investors will get deals and make decisions, right? The nice thing is you're not liable for the loan. Okay, so if for whatever reason the market completely crashes and then this $20 million apartment is now only worth 8 million, okay, the bank will not go after the passive investors for the difference. Okay, so you'll never lose more than what you have invested. Okay, so other than that, you don't really do much. You just sit at home and you wait for your distribution checks to come. That's really it. But another nice thing is, at least on the deals that I invest in, the shareholders have certain rights. Okay, so the most important share voting right that you have is the ability to vote out the active managers if they're not doing a good job. Okay, not all deals have this provision. I personally would not invest in a deal unless I have the ability to vote out the active managers if they're not doing a good job. Okay, there has been a case where there was a guy that bought a large apartment, couldn't handle the load, gave up, disappeared, ran off to Mexico, right? So at this time, the partnership needs to take a vote, put in somebody else that's worthy, and continue on with the investment, right? This is extremely rare, but it might happen. So when I set up my deals, I set it up the way that if I was a passive investor, that's how I would want the deal to be, right? Because I came from a passive investor background. So the passive shareholders also get a chance to vote on whether or not to sell the deal. Okay, so usually the active manager says, hey, this is a good time. I think we've made a lot of money. Or it's like, hey, we haven't quite hit our goal, but I think this is the best timing to sell right now. Okay, we'll get the most bang for our buck. So they'll present this proposal to the shareholders, and the shareholders would vote on whether we should sell or we want to hold it longer and keep getting the cash flow. Okay, so passive investor has certain rights. And that's the kind of deal that I want to invest in. But other than that, you don't have to get involved in the day-to-day. Okay, you don't have to worry about like the loan. So it's very hands-off, which is great. So you can probably guess by now, choosing the kind of sponsor that you want to invest with is very, very important. Okay, so what kind of risk are you willing to take? What kind of pilot do you want to invest with, right? You can invest with somebody who is going for riskier things, such as a new construction or a complete major rehaul of the apartment. There's a potential for much higher return, but the risk is correspondingly higher. And I have also invested in this type of deal because I want to know what it is like. What kind of risk am I really taking on? So, and then you can choose to invest with somebody who's more conservative. Okay, so lower risk. Okay, and for these type of sponsors, their goal is really, number one goal is to preserve the investor's capital. Okay, so these people tend to hold a larger reserve. Okay, so when we hit times like COVID, there's enough money, the business will continue. You won't lose your original investment and that type of thing, right? So I'm the conservative type. So in my projections, in the way I operate my property, I tend to be much more conservative in terms of like the renovations that we do, right? Renovations typically are lighter renovation, not like a knocking down wall type of operations. Any questions on this so far, on the syndication part? Okay, So this is pretty much what I do. So every month, basically flying to different places to check out different deals. You know, of all the properties that becomes available, I typically walk the property with my property manager. So this is a property manager that I was planning to use in Austin. So I will walk the property with him to see, you know, what are all the fixes that we would need to do, what are some of the renovations we can do to increase our value. Okay, so here is one unit being, you know, doing a very light renovation. Okay, what this is what the result would probably look like. You know, so it is also our job to get to know the large commercial brokers. So the thing about multifamily is majority of the apartments are basically being sold by maybe 7 or 8 companies. That's it. It's not like residential where there's a bunch of agents, right? No. When you're selling something that's 30 million, 60 million, 100 million, it's the large national commercial brokers that do these deals. So companies like CBRE, Marcus & Millichap, you know, JLL, etc. Right? So these are the largest commercial brokers that sell office buildings, that sell malls, that sell all these things, right? So they hold on to all of these inventory. You don't deal with individual agents here. Okay, so, and it's a country club, right? It's a country club mentality. You have to get to know the broker, be good friends with them, be in the club before they would still start, you know, sending deals to you, telling you about, you know, things that are off market, that's coming on the market, etc. Okay. So yeah, so it could be, you know, a few years of walking properties, checking out different deals before you find one that actually makes sense, right? You know, because right now it's a market where everybody's overbidding, everybody's overpaying for properties, right? So if I don't feel I can get the kind of return that I project to my investors, I would not buy it. Okay, so it wouldn't be good for anybody, right? So I'm pretty careful in the type of property that I select. And it's also very important to walk with somebody that is knowledgeable in the area. So some of you may know him. This is Mr. Paul Peebles, also known as the Godfather in Dallas. So Paul is a lender. He is one of the largest lender in Dallas. So he pretty, you know, I would say majority of the transactions in Dallas, he knows about it. Okay, so for example, this one property that we walked, he knows who the seller is. It's a party based out of New York. He knows like who the previous 3 sellers are. And then if there's any bodies buried, he'll know where it is. So it's quite important to you know, walk with somebody who's very familiar with the area. So yeah, we would check out deals, we underwrite. I think on this trip, I saw about like 12 properties, but I think in actuality, there's only 2 that I was willing to take a closer look on and bid on. Okay. So we kind of covered like the different cap rates, but basically, you know, Class A, Class B, Class C, the US kind of went through different periods of construction, and you see very different stylings, right? So Class C is probably 1960s, 1970 vintage, okay? White appliances, it has swimming pool, all that kind of stuff, but you know, it typically have a flat roof, so that type of property, right? So rents are obviously cheaper, okay? Class B is basically your low rise, your garden style type of property. So this is probably 1970s to the 1980s type of build. Okay. And then you have your class A's, which is, pretty much year 2000 and on. Okay. So there was a period of time where there was a lot of single family construction during the 1990s, and they didn't build that much new apartments. So that's kind of where they kind of separate. So for us, the type of apartments that we invest in, we don't invest in class A that much. We primarily invest in class B and class C. Okay, and there's a reason for that. So as I mentioned, we want stability during a downturn, right? I'm not sure if everybody knows, but like during this COVID downturn, San Francisco class A is like dead, right? I mean, they were charging $4,000, $5,000 per unit, right? It just, nobody wants to pay that, especially not during remote working times, right? So what we see historically is during a downturn, people can't afford class A. Okay, so the class A people would move down to class B. Okay, and the class B people move down to class C. And then the class C people do not move down to class D. D is basically gangland, okay, really poor neighborhood. And the people in class C will do whatever it takes, okay? Families moving in together, etc. They will not move down to class D. So when the economy is not that great, class B and class C do exceptionally well, okay? Class A right now in San Francisco is probably 60% occupancy, 60, 70% occupancy, and then they're having to offer 2 months of free rent in order just to attract renters, right? So they're doing really bad during the downturn. But class B and class C, 90% occupancy, 90% collections, right? It does extremely well. Okay, so one thing I want to touch on here is this cap rate. Remember, cap rate represents how expensive something is. It's income divided by selling price. Okay. So conversely, what that means is for a 5% cap rate, that means for every dollar of income is equal to $20 of value. Okay, so one divided by 0.05 is 20. Okay, which means that if an apartment makes $1 million a year in net operating income, then this apartment is worth $20 million. Does that make sense? It's a business, right? So if you're doing great, if you can make $1 million a year, hey, your apartment's worth 20 million, okay? If you kind of suck and you can only make $500,000 a year, well, then your apartment is only worth $10 million. Okay, so our model is to buy these apartments, okay, and then be able to do a small renovation, be able to push a rent, be able to, or find other ways to create more income. So by increasing the income, every dollar of income that we increase is multiplied by 20, because that's how profitable the business is, right? So if we buy like a property that's generating 0.9 million of net income, right? So 0.9 million times 20, that means this property is worth 18 million. So if we buy a property that can make 0.9 million and we can increase the income to 1.1 million, okay, multiply by 20, that means this property is worth 22 million. So we just turned an $18 million property into a 22 million property. Okay, so because it's a business, right? So the more profitable you are, the more your property is worth. Okay, so this is a business plan that we know how to execute. We know that, hey, if we renovate, we can charge rent extra by this much. And if we renovate X number of units, that means we will get how much of extra income, and that will translate to how much extra value this apartment is. Okay, any question about that? I mean, that's a pretty that is a pretty important concept, and I'll try to illustrate that again. Okay, cool. So I'm going to take a quick break and answer a question that came in through the chat. So there was a question on how are active managers compensated? Okay, so it's a little bit different for each group, but I'll tell you how the deals that I invest in and also how my deals are structured. So the way that the active managers are compensated is mainly on profit. Okay, so asset managers are compensated 3 ways. Okay, the first way is acquisition cost. So when we buy an apartment, okay, the active managers get a certain, maybe like, I think like about like a small amount, something like 0.5% to 1%, okay, acquisition fee. And this is to cover maybe like the 2 years, the half a year to a year or two of them looking for the property. Okay, but that's a fairly small amount. Okay, and then they're also compensated on while the property is being managed. Okay, so that's called asset management fee. So we take very low active management fee, maybe something like 1.5%. Okay, which kind of translates to about like $1,500 a month divided amongst 4 people, right? Which is like nothing, right? It barely covers plane tickets or whatever. But active managers don't get compensated through operation. Active managers mainly get compensated when they deliver profit. Okay, so which means that if during the process of us operating a property, if we're profitable and we're able to share the profit with the investors, then we take a share of that profit. If the property is not generating any profit, we're not taking any money. Okay, and also when we sell the property, after we sell the property, money is returned to everybody first. So if you invest 100K, you get your 100K back first. That's the first thing that happens. Now, after giving everybody's money back, if there's profit left over, then the active manager will take a portion of that profit. Okay, and the remainder goes to the passive investors. Okay, so it's set up this way to incentivize, to make sure that the active managers work hard. Okay, because if they are not able to generate a good profit, they just wasted 5 years of their life for nothing. So, so active managers only get paid on profit if there's profit. Okay, so hope that kind of answers that question. Okay, so we typically do what's considered a light renovation. We're not tearing down walls. We're not like, we're not completely overhauling the thing down to the studs or something like that. We do a light renovation. Okay, so if you take a look at the 2 pictures, you'll notice that the cabinets are actually just painted. Because we buy in large quantity, this goes back to scale, right? So things are cheap. Okay, so for me to buy this granite slab, like a 8 feet pre-manufactured slab, this whole slab is $99 to me when I buy it. Okay, to put on this backsplash is like $80. Okay, and then my maintenance staff puts it on. These faucets, this faucet is probably like $40. Okay, to get a whole black appliance package, that means a refrigerator, the stove, the dishwasher. So this 3 appliance package cost us about $650. All right, it's super cheap. It's probably half a price or less compared to if you were to buy these at Sears or something. Okay. Flooring, $1 a square feet. Okay. So a lot of these things are shipped directly from China in bulk containers. Flooring alone, the property management company we work with, they ship 4 containers per month just to supply the apartments in the Dallas-Fort Worth area, right? So you can imagine, with that large amount of quantity, things get really, really cheap. So a renovation like this to go from here to here is about $3,000. It's about $3,000 to turn the whole to turn the whole unit. $3,000 to $4,000 if you want like a little bit better stuff. But these are usually done in about 4 days with our on-site staff. We don't hire outside people, so we have maintenance guys on site, and so the maintenance guys take care of anything that breaks: toilets, windows, electrical, etc. And when they're not working on maintenance work orders, they're doing renovations for us. Okay, so they're the ones that's putting on the glass tiles, they're installing the granite, all that kind of stuff. They're putting in the new appliances. We don't pay extra. It's all part of their salary. So yeah, so $3,000, $4,000 to renovate a unit is really good deal. So here's another example. Upgrading from white appliance to black appliance. It looks nicer. Putting on some simple backsplash, and we charge anywhere from $75 to $100 extra in rent for this kind of renovation, right? So would you pay? I think for $100, I would live here. I would pay the extra $100 a month to live here. And the nice thing about like something like this, you see this countertop, it's not granite. It's really just poured over paint. Okay. So you can, there's a lot of resurfacing you can do to make it look like granite. And to do that, it's only like $100 or so. So it's very, very cheap. Okay. So here's what a rough breakdown of our renovation costs look like. So backsplash, maybe $100, to paint the cabinet doors, $100 or so. Our guys do it, so it's pretty easy. To change out the miscellaneous hardware, fixtures, all that kind of stuff, about $300 for the whole unit. Black appliance package, if you buy new, it's $800. Right now we're getting them for $650 because there are certain apartments that's upgrading to all stainless. Okay, they're upgrading to all stainless, and then they're selling their almost new black appliances for like super cheap, right? So we can pick them up for about $650 for a set. So vinyl plank flooring, about $900. To resurface the countertop, about $100, and then to repaint the whole place. You don't always have to repaint the whole place, but if you had to repaint the whole unit, that's about $700. So yeah, for $3,000, you're done. Okay. Even if you conservatively just say that I'm just gonna bump the rent by $50, right? That means you can increase your annual income by $600. Okay, so you'll get your money back in 5 years. Okay, but remember, every dollar of extra income that you have is multiplied by 20 in terms of like the apartment value. Okay, so this extra $600 of income means $12,000 in extra apartment value. Okay, so in the end, you gain about $15,000 in equity, and you only invested $3,000. Okay, so that's how we're able to force the appreciation. We're able to generate more income using a one-time cost, generate more income, and then that's how we're able to double our money. Yeah. Any questions here? One question. Is the paint done by our maintenance guy? Yes. So things like touch-up paint or painting the cabinets, most of these are done by our maintenance guy. Okay. If it involves like painting the whole unit, we usually contract that out to the outside company. They do it really fast and they can do a few units in a row. Okay. So yeah, this $700, $800 for paint is to be done by an outside vendor. Okay. So how is this done in 4 days? Well, typically we would have somebody come in to do the flooring, an outside company to come and do the painting, our guys do the cleanup, put on the tile, paint the cabinets. We have an outside paint vendor that does the resurfacing, and then yeah, so 3 or 4 days, you know, you do the paint. Once the paint is dry, you can put on the flooring, so it gets done pretty quick.
And Tony, where do you get the black appliances? Is there like a wholesaler or in between guy or?
Yeah, so for apartment vendors, I mean, for apartment owners, there are supply warehouses that we purchase these from. Yeah, and they usually want, you know, to know that you plan to be buying in large quantities. So it's hard to just go and buy 1 or 2 appliances. When they know that, hey, you're from an apartment, they know that you're going to be buying in bulk. And for the property management company that we work with, they have approved vendors for these things, and those vendors know that, hey, if I offer a good price and I work with this property management company, their owners will all buy from me, and I can get much larger deal, so cheaper discount.
What about washers and dryers? Do you offer those in the units? Like that's $100 bump a month, right?
So for washers and dryers, not every apartment have a washer and dryer connections, and typically we rather contract that out to somebody else. It's because we're already, you know, maintaining a lot of appliances, right? And we don't really want to be responsible for fixing laundry and dryers as well. So we typically refer people to, you know, external rental services. Say, hey, if you need a washer and dryer, you can rent it from these people, and we get a cut of the commission for doing that. So this way we still get income, but we don't have to worry about maintaining the washer and dryers.
But y'all put the hookup in though.
Yeah, the hookups are usually there when the apartment's built. It would be very expensive to add a hookup.
Yeah, go with that right now.
Yeah, and then also, you know, for these washers and dryers, you need a place to store them, right? Because some people may want them, some people maybe bring their own. Then you need to like rent a trailer and then, you know, have 10 sets of washer and dryers just sitting there ready to be used. And there's better use of my maintenance guy's time. Yeah.
Yes.
So Luke asked, go ahead.
Yeah, I was explaining the exact same numbers today to somebody and how to get the return. Except for us doing these same things, I could increase the rent $100 bill.
Yeah.
Yeah, immediately, like tomorrow. It's kind of crazy.
Right. I did mention I was conservative. So in Dallas Fort Worth, when we do these kind of renovation, we're actually able to charge $75 to $100. But you know, let's just say conservatively $50. And you know, this is what we can get. So Luke asked, labor and materials have gone up quite a bit. Does that affect the apartment? Yes, it has. But you know, what has really gone up is the lumber prices. Man, the wood is expensive right now, okay? Labor is also expensive, but for the wrong reason. So right now, maintenance guys are kind of expensive. And the reason is not because there's lack of maintenance guys. It's because they're making about the same, if not more money, sitting at home collecting unemployment benefits. Okay, so collecting unemployment benefits plus the 300 or 400 extra per week, there's very little incentive for them to come out and look for work. Okay, so that's been that's been hard. That's been hard, and then it's actually hit us for a whole year so far. But normally, for maintenance lead, we pay maybe $18 to $20 an hour. Okay, for somebody to do make readies, basically turn the unit, we're paying like $16. It's not that much. In California, that's probably double. So Terry asked, you mentioned they're salary based. They're actually hourly based. Sorry. Is there a salary increase accounted in these 5 years? Yes. When we do our 5-year projections, we usually have a certain percentage we expect the expense to increase by. Just like the rent, we might expect the rent to grow maybe 3% a year. We will probably expect the expense to also increase maybe by 2% a year. So this all goes into our calculation about how the business plan will work out. So what is expense like pool, cover parking, irrigation, re-roof, etc. So these are, there are basically 2 types of expenses. There are normal everyday expense. Okay, we call them operating expense. These are like toilet breaking. These are like, some leaks here and there. Somebody want their faucets to be replaced. Small things, right? Things that just break normally. Okay. And then there are large things like completely changing out a roof. Okay, or something like that. Give me a second. Okay. So so we typically factor those into our projections once again, right? So we make a projection based on the previous years of expense. It's pretty safe to assume that your expense will not be too far off from what the expense was the previous year. Okay, for the normal operating expense. And then there are the capital expenditures, like major improvements, right? So when you take over a property, maybe there's a leak in a pool that you have to fix. Maybe the roof is bad and you have to replace. So those are part of your purchase projection. So if I'm buying a property for 10 million, I probably have to put in another, $500,000 to $1 million to do major capital fixes, right? So that means I need to raise an extra $1 million for fixing them. And then I probably want to raise another $500,000 to do the renovations, right? So all these will get calculated when we have, when we're working on the deal to decide what the business plan will look like. Okay. So how are you able to get all these appliances for $800 when one refrigerator is around that? Yeah, so buying in bulk makes a huge difference, okay? And these apartments trade appliances with each other, and we really only buy like the 1 to 2 year old appliances from other people if we're buying used. So like I said, Class A units, they're probably changing to stainless steel appliances, getting rid of the black appliance so we can buy them cheap, okay? Then we're also getting rid of our white appliances, right? So there's other people buying our white appliances and they're getting them cheap, right? So the cycle kind of goes on, and that's how we're able to buy them cheap. Okay. Do you change out hot water heaters to get tax credits? So in terms of credits, what the most benefit that we do get from like replacing water or doing water conservation is mainly from the loan side. Okay, so if these are called green programs. So if we're able to show that, hey, we can reduce water usage by 10% or 15%, right? And then we can reduce electric usage by 10%, then they will actually lower our interest rate. Okay, so instead of 3.5%, we may qualify for 3.2% if we do these green renovations. So how do we get these? Well, we typically put in like a low flow toilet. So instead of one flush is like 5 gallon, we'll probably put in a 1.2 gallon flush toilets. That saves a lot of water. Electricity, we would convert all the lights to LEDs, and that would save a lot of electricity as well. So by doing these, which we probably would have done anyways to lower our overall expense, we can enjoy a lower rate and a lower expense. Okay. Do you usually include utilities in my apartments? So the question is, do you include a utility in your rents? Okay. Typically, no. Okay. So typically newer properties like Class A and Class B are individually metered, meaning every unit has 1 meter. So they usually pay their own utility. Okay. And then on Class C properties, okay, these people, are not as sophisticated. These are your working class people, Walmart, retail store type of tenants. So sometimes they like to see one bill. Okay, so just charge me one thing, which includes water and electricity, right? That's called all bills paid. We don't typically do that. We don't typically like to do that because we know that if we do all bills paid, then they will then they'll leave the AC on all day. They'll keep the water running just for the sound of it. I don't know, but it gets ridiculous. So we want them to be responsible. So we in Class C properties, we typically, these don't have individual meters. So we're getting billed as an entire property, but then we charge them back based on how big their unit is. Okay, so we get one big bill, and then everybody, 2 bedrooms pay one price, 1 bedroom pay one price, and we get the money back that way. Do you evict your tenants if they don't pay right now? Yes, we do. And that's why I love Texas. So in California, if I'm a tenant and I live in San Francisco, I will guarantee you I can be there for 2.5 years. I can drag this thing on. There's free lawyers that will help me to fight the evil landlords. You will not be able to kick me out. Okay, I'll stay there rent-free for 2.5 years, no problem. Okay, that's why California sucks as a landlord. Meanwhile, in Texas, if you don't pay, you don't play. Okay, so I'm able to evict tenants in 3 weeks. It only takes me 3 weeks to get rid of a tenant. Okay, even with the current CDC laws and all that kind of stuff, I can find ways around it. Okay, I can find ways. I can still get you for noise or lease violations, or not picking up after your dog. I can find excuses to get rid of you. Okay, so yes, we're still evicting people. Even if you do a CDC declaration, I will challenge your declaration, and we win majority of those challenges. So that's why in my property, we are, as of this month, we're collecting 7% more than pre-COVID. Imagine that. During COVID time, I'm collecting more than pre-COVID because they know that, we're serious. So every month, maybe I will evict 1 or 2 people. Basically, when they get evicted, we move all their belongings outside the apartment and just put it out there, right? they had to collect it within a day or it goes into garbage bin. But when you set out all their belongings like that, it sends a message to the rest of the tenants that go, oh, okay, they're serious. They are evicting people. I need to pay on time. I hate doing it, but these are usually like the worst of the tenants. But you do have to let them know that, hey, we run the property, you don't run, So Texas is very landlord friendly, and that's why we like it there. Cool. Good questions. Good questions. Okay. So what does the investment, how do we go buy one of these properties, right? So let's say a property is 10 million. Okay, 10 million. So we usually are able to get 70 to anywhere from 70 to 80% loan. Okay. So that means on a $10 million property, we're putting down about $2.5 million of down payment. Okay. And then we also have extra money for doing the renovations, for doing any major fixes, and also some money for the reserves. Okay. So that means together we need about $3 million to buy a $10 million property. Okay. Maybe a little bit more than this. I mean, we usually need about a third. Okay. So if you're buying a $20 million property, that means you probably need to raise about $6.6 million. Okay. So, but let's take $10 million, for example. Okay. So we're basically raising $3 million to buy this $10 million property. And our goal is to double everybody's money. Okay. So that means we want to be able to sell for, we just need to increase the value of this property by another $3 million. Okay. So if we double, so we put in 3 million and then we get 6 million back, we have doubled everybody's money. So we're not trying to take this property from 10 million to 20 million. That's too hard. Okay. That's a really hard way to double your money. We're just trying to gain an extra $3 million of appreciation. Okay. So we're just doubling our investment. Make sense? Okay. So yeah, take this for example, so we have a 7.5 million loan, and then if we can sell for 12.5 million minus 7.5 million of loan, minus the $3 million of principal that we give back to our investors, we have a net equity gain of about $2 million. Okay, so the profit that we make is actually comes in two parts, right? One is when we take over the property is usually already profitable, right? So we're able to share the profit as cash flow to the investors. So in today's world, you're probably looking at 5 to 6% cash flow a year. Okay, so if you invested 100 grand, you probably get about $5,000 to $6,000 a year back. Okay, so that will continue for just about almost every year. Okay, so over the years, you'll be collecting cash, right? So that's a nice thing, right? It's giving you a good return. And then when you finally sell, so after 6 years, maybe you have collected $34,000 in cash flow already. Okay, and because of depreciation laws, you actually don't really pay taxes in any of these years. Okay, you don't pay tax. When we actually sell the property, let's say in year 6, the property would have also appreciated because of the renovations that we're doing. So, so at exit, you would have received maybe $34,000 in cash flow, another $58,000 in appreciation, and that doubles your $100,000, right? This is your $100,000 original principal that gets returned to you first, and then you get probably get about 1/3 of cash flow as your profit return, and 2/3 will probably come through the appreciation part. Okay, And the appreciation part, comes back when you sell the property. So typically, I think in today's market, you're probably looking at about 12% return overall on an annual basis. Okay, so a few years ago, I think people were able to do 18% returns, 17% returns, but things have gotten a lot more expensive nowadays. And I think a more realistic return is probably, to be honest, about 12% return. Okay, I've seen people who are honest with their numbers would probably project 10 to 12% return. Okay, and then there are people who kind of exaggerate, like what are they able to get, and then they will still underwrite and tell you, hey, I can get you 17, 18% return. Those are possible, but that's if they do everything perfectly, if the market behaves perfectly, if the renters pay perfectly, then yes, you can hit 17 to 18%. But more realistically, so I typically tell my investor, I think I have pretty high confidence I can deliver you 12% return. I can probably do better than that, but I'm comfortable with a certain amount. Quick question. So in your syndications, are you looking for long-term cash flow or looking to sell in X number of years? Okay, so our goal typically is not to hold it for X number of years. Our goal is really to double everybody's money. So if you invest $100,000, I want to give back to you $200,000. Now that may happen earlier or that may happen later, right? So the past 5 years in Texas have been really great, right? Really, really great. I've seen deals, I'll show you some of the deals I invested in that doubled in 2 years, sometimes, doubled in 3 years, right? But then, you also get periods where COVID hits, right? Or a slowdown in the economy that typically adds another 2 to 3 years before it recovers, right? So potentially, instead of exiting in 5 years, if the market is good, you'll exit in 3, right? If the market is bad, well, then probably takes about 7 to 8 years before there's a reasonable exit, right? So, so for these investments, please remember these are long-term business plans, right? We're not trying to get rich quick. We have a plan, we have a business plan that we execute on. And we're working for the long-term result, right? But it's modeled this way, and we get like a long-term loan, right? The rate is guaranteed for 10 years to 12 years because we want to make sure it is safe, right? We can survive any downturn. So, I hope that makes sense, right? We're this is a more conservative way of doing things. There are people that would project like, we're going to take a short-term debt, right? More expensive, and it's only 2 year. It's only a 2-year loan, and then we're going to try to refinance, and then we're going to try to sell the property at year 3. I think some of those work. It's just not, I'm not that kind of pilot. I'm a more conservative pilot. Okay. Okay. So who gets to use a depreciation expense in these 5 years? You as a limited partners do. So every year, we would issue a partnership return. Okay, that's called a K1 partnership return. So in the K1 for the first year, what you'll actually see is, hey, you receive $6,000 in your bank, okay? And the K1 says you have $6,000 of income, but you had $70,000 of depreciation loss. So on paper, even though you have $6,000 in the bank, you actually don't have to pay any taxes on that because of the accelerated depreciation. Okay, so every partner get their portion of the profit and depreciation loss based on how much you have invested, right? So everybody is proportional. Okay. Question, are the passive investors 1099? No, those are K1. Those are K1 partnership reports. Do the investor get a tax benefit? Yes, you absolutely do. That's why I was investing passively, because of those tax benefits. So all those things I talked about, 20% of the profit doesn't get taxed. Long-term capital gain is that, so your appreciation taxes at 15%. All those things flows all the way to the limited partner, basically the passive investors. Okay. Cool. Any more questions? Okay, I'll keep going. So this is a sample, I'm sorry, this is a little out of date. Numbers are not nearly as good as it used to be, but the numbers are still way better than what you can get in the bank. So, right now you're probably looking at about 6% yield a year. So year one, you'll get $6,000 in cash flow. Most likely you don't have to pay any tax on that. Year two, another $6,000. These are usually distributed either monthly or quarterly. Okay. Yeah, so you keep getting distributions either monthly or quarterly until the time that we sell, where you'll get a big chunk of the appreciation. Okay. So the idea is put in $100,000. We do these light renovations. We increase the property's income, and we're now able to sell it at a higher value because it's a much more profitable business that we're selling. Okay. When you have multiple investors in one deal, how do you make sure everyone is on the same page? Yes, there is absolutely there. So remember, these are SEC regulated entities. So anytime that you have a deal, let me see if I can share this. I need to be very careful about what I open. Give me a second. Let me just open up an example. Okay. Let me see if I can share this. Okay. Can you guys see this? Are you guys able to see the PDF? Anybody there?
Yes.
Yep.
Okay. Okay. So, so when we have one of these LLCs, anytime we buy, we put out basically a partnership agreement. Okay, so in addition to a partnership agreement, so this spells out everything about the LLC. What is the, who are the officers, who are the members, what are their duties, what is the, it spells everything out. It's a whole SEC document. Most people don't read it, but I do. If you want to read like 100 pages, yeah, as your bedtime reading, feel free. But this partnership agreement will spell out everything. What is the the profit distribution? What is a split percent? What are the duties? Who are the members? Who's responsible for what? What are the voting rights, etc. Those are all clearly spelled out in the LLC agreement. And also it spells out what is the investment that you're investing into, right? So the PPM is what we call it, is all filed with the SEC. So yeah, there is a contract. How do we protect our investors? So remember, my model is just like, what some of the most famous investors have said, number one, don't lose money. Number two, refer to number one, right? So, so my goal is to not lose money. And anything that we invest in, be it stocks, be it real estate, be it whatever, there's always going to be risk. So it is our job to mitigate, reduce as much of this risk as possible, right? So one way we do this to prevent people from being from any limited partner from any lawsuit is we set up a protected LLC, right? So individuals will never get sued. Well, what happens if somebody falls, right? What if there's a fire? What, burn down the building? What if there's a hurricane? We buy insurance for that, right? What if somebody slips and falls in the what if somebody slips and falls in the apartment and sues us? What if other things happen, right? We actually buy a $10 million umbrella insurance policy for all of our assets. So, we make sure that risk is also mitigated. So everywhere we can, so what if we go through a COVID time, right? Well, then we keep a large reserve. So for example, when COVID first hit, we had about, on one of the properties, we had about $400,000 in reserves, okay? And that's really a rainy day fund exactly for economic downturn, etc. Okay, so we calculated that if our occupancy drops 40%, if our occupancy go all the way down to 60%, then our reserves are good enough to last us over about 13 months. Okay, so we felt pretty safe. Okay, so in that really, really bad situation, okay. The truth is, it never got that bad, okay? We were profitable every single month during the COVID times. So, even during a downturn, apartments are profitable, okay? So generally, the properties that we buy, we can drop down to about 85% in occupancy and still be profitable, okay? So we can drop down usually to about 85, maybe lose $100 on rent, and we're still breaking even. Okay, so we're not losing money. It's only when you go below that do you have to start using your reserves. So we do everything we can to mitigate all the risks that we can see. It's never zero, but yeah, we do the best we can. Okay. How does that appreciation get taxed? Because it's such a large chunk. It's taxed as a long-term capital gain. This is a long-term deal, right? We're not likely to exit within 1 year. That's very unlikely. So over 1 year of a long-term hold is long-term capital gain, 15%. Yeah, unless you make a lot of money, then that's 20%. Is there a special marketing package you provide to doctors and sports professionals? Well, we have our standard marketing package, and it's usually not too complicated. I try not to be too technical, but if I gave you the marketing package, you'll understand it. Don't worry about that. So how do you have money in reserves for hurricanes? You don't want to have money in reserve for hurricanes. Hurricanes are really covered by it's supposed to be covered by your insurance, okay? Flooding, these kind of major things, that's what your insurance is for. You need to make sure you have enough money for your deductible, right? And for large apartments, deductibles anywhere from like $10,000 to $25,000. Okay. Do you ever sell and then turn it into a 1031 exchange? So a 1031 exchange is where you don't have to pay tax on your profit, right? Because you're invested into the next deal, right? That's much easier to do on smaller deals. It's much harder to do on larger deals, because basically all the limited partners have to agree to not take the money out and invest into the next thing, right? So yeah, if you can imagine, if I tell you that, hey guys, I know you invested $100,000 each, we have doubled your money, but let's not take out that money. Let's go for another 5-year investment. Chances are people are going to say, no, I want the money. I'm going to go buy a boat. So it's hard to get everybody to agree and go as a group to the next deal. But if you only have 2 to 3 people, then usually it's much easier to do. But it is an option, and it is, if everybody's interested, we would do something like that. Okay. What is a limited partner and general partner split at sale? Once again, it's very different for each syndication, right? I've seen people do 20-80, where 20% of a profit goes to the general partner and 80% goes to the passives. I've seen 30-70, 70% goes to passives. I've seen people go all the way up to 50-50. We're anywhere from 16% to the sponsors. 16 to 20% is kind of our range, depending on the deal. So we like to make sure that our investors are paid, because the investors are our friends and people who trust us, and our feeling is we want to make money together, right? So if there's a good opportunity, everybody can make money together. Ooh, that's a sad question. What happens if the passive partner passes away or become incapacitated? Usually then your either your heir or the person that takes over your asset becomes the new owner of your share of the deal. So it's like an asset, right? So it does get passed down to the next person in line. You don't just lose it. Okay. So here are some examples of the things that I invested in. So this was not a typical deal. This was a very large overhaul. Okay, remember I was doing about $3,000 a door of renovation, light renovation. These guys were doing $15,000 a door, major renovation. Okay, so it was pretty scary because the occupancy went from 92% all the way down to 60%. Everybody was moving out during the renovation, right? It was so bad that the sponsorship team put in $800,000 of their own money into the deal to save it. Okay, and then they actually saved it, right? All the renovations were done, and the deal was just sold this quarter. So it was about 2.5 years. The deal lasted about 2.5 years, and we ended up getting about 70% return. Okay, so that was good. It was excellent return, but it was pretty scary, right? Big risk, big return, but it almost went south. We almost lost all our money, right? So when you do your investment, consider the type of risk you're also taking. So, but this was a large company. I had more faith. So my general, when I'm investing, one of my general rule is invest with people who already have money. Okay, invest in people who are already rich, because these people care a lot about their reputation. Okay, so and when things don't go well, they're more likely to put their own money into the deal in order to save it. Okay, so and also another thing is when you invest, you want to make sure that the sponsor, the lead group, has also put their own money into the deal. Okay, because there's nothing like, oh my God, I'm going to lose my own money, to make sure that the active sponsors are working hard. Okay, so for example, like on the previous deal that you saw on the top of the page, on this deal, the 4 sponsors, we put in $600,000 of our own money into the deal because we think it's a good deal. We want to make money from it too. So, we wouldn't market a deal that we don't think it's good. So, and we want to get in on the action as well. Okay. This is a deal I looked at, but ultimately did not invest in. This was in Las Vegas. It was a student housing deal. And the goal was to turn to student housing, turn to 2 units. There were a lot of issues. With this student housing investment, they missed the window. They didn't finish a lot of renovation before school started. And by that time, by September, all the students have found housing already. So if you're not full at September, you're not going to be full for the next 8 months, right? Nobody's really moving in. They already got their lease. So this place was like 20 to 30% empty for almost a year. Okay, and that killed it. Okay, so when I went there, I saw that there were 20 empty units that had asbestos that need to be treated. I said, hell no. And yeah, sometimes you have to see the deal and kind of understand. One question: what is the minimum commitment required for investor as passive? So most deals that you'll see is $50,000 to about $100,000. Okay, so most frequently I see increments of $50,000, $75,000, or $100,000. So a few people invest more than $100,000, right? And the nice thing is you can actually use your IRA retirement funds to invest in these properties. So you basically do what's called a self-directed IRA. You convert your IRA into a self-directed IRA, which is able to invest in Bitcoin, startups, precious metals, syndications, all these things, right? So I was able to leverage my rollover IRA and to invest in like 5 of the deals. So you can get much better returns. So if you have questions on how to do that, we had a meetup last time about this, and I can share the information with you. Quick questions. Sorry, I'm just answering some more questions. Have I done any deals around Henderson? No, I don't typically invest in Las Vegas. I invested single family there before. It's a roller coaster. So when I pick areas to invest, what I want to see is a consistent population growth. That's usually the most important thing, consistent population growth. Because with population growth comes job growth. With job growth and population growth, then you will get your rent growth. Okay, and rent growth is going to be a main driver for increasing value. So, you're going to find like some suburbs that, where the deals look super cheap. You can get units for like $50,000 a door, but that's because it's also very risky, right? It's not a major employment center. So follow the people, follow where they're migrating to, right? So Dallas-Fort Worth, why do I like Dallas-Fort Worth so much? They're getting about 100,000 people a year moving into DFW. 100,000 people a year. That's like the size of San Mateo every year, right? So that's a lot of people, and that's a lot of job growth. So, and these people need a place to live. So if you look, they're building a bunch of Class A's, but most people cannot afford to live in the Class A's. They want Class B and C's, right? Where the rent is more affordable. But they're not building more of these. There's a fixed number of these. So why? so that's why we invest in these that they're not building anymore. Okay. Question: why population growth and not job growth? They actually usually go hand in hand. Yeah. Can you share returns and past results? So in our partnership, we had together we owned about 12 apartments, 13 apartments so far, and we went full cycle on 6 of them already. So full cycle means from purchase to selling, so six cycles. So some of the most recent ones, we were able to sell them in under 3 years. Please don't use these as reference. The last few years in Dallas-Fort Worth was crazy, like 120% over 2 years. Please, I think if we happen to hit that situation, great. Okay, but that's just a sign of how strong Dallas-Fort Worth has. It's not an indication of future returns. Okay. How many projects am I usually running? So right now usually one person can handle about 2 projects at the same time. So really don't want to be handling more than 3 to 4. So you'll find these partnerships, they grow in size, and once expanding to one point, we'll actually hire employees that help us underwrite deals and manage a property. So, but we're not anywhere close to that yet. So yeah. Usually anywhere from 2 to 4 projects is fine. Yeah. Okay, cool. Why population growth? Oh yeah, I think I answered that. Yeah, they're basically hand in hand. When the reason why you have a lot of people moving to a certain area is because there are a lot of jobs there, right? So they kind of go hand in hand. So right now we're seeing a large exodus of people from California, mainly to Texas, and also from New York to Texas, right? Within California itself, you see people running away from the city, San Francisco, Mountain View, to like more suburbs like Sacramento, the cheaper rental areas, right? You can still drive into work once a week, on our drive, but yeah, people are getting away from the really expensive places. So I went to Austin, I was there and checked out the neighborhoods. Austin is great and all, there's a lot of jobs upcoming, but I personally think it's overhyped compared to the number of jobs that is increasing compared to the number of people that's coming. It's not a direct correlation yet. So yeah. With COVID-19, working from home, single family real estate is very hot. Yes, absolutely. How do you think that impacts the apartment market? I actually don't see it as a big problem. So one thing that I'm also seeing extremely in Austin is, there's all these people that move to Austin that want to buy a home, okay? But because of remote working, because of all these reasons, people, the housing price is going crazy there, right? People can't buy a home because there's such low inventory. So they actually end up sitting in apartments, waiting for the right time to buy. So when the single family home is really hot and nobody can get in there, apartments are still full. So it's very weird. It's just the apartment occupancy is just very, very steady. unless you go to the edges, right? So unless you go to class A, then class A is very seasonal. It depends on the market. It depends on the economy. But the core B and C is very stable. Yeah. Yeah. So, and then, am I looking to grow in other markets? Yeah. We look into other markets as well. But right now, we look at Phoenix, we look at Atlanta, Georgia. We look at a lot of different markets, right? But in terms of the performance, they're all actually very similar to Dallas and Fort Worth. Phoenix is very close to California, so you get a ton of California investors all rushing there, right? For the new TSMC factory, all this kind of stuff, right? So Phoenix is not cheap. Okay, if anything, it's more expensive. Austin is also extremely expensive, right? So if I look at it and it's a similar amount of population growth, and it is also, if I can get similar or the same return, then I'm gonna stay in Dallas-Fort Worth area, right? Because, for me, why did I go to Austin? Because in order to invest in a new area, it takes time, okay? It takes time to do it right. So when I went to Austin, I interviewed 5 different property management companies, okay? I need to build up my team there. So I need to get to know the brokers, right? All the major players there. I need time to build up, like, who's a lender there? Who is going to be my renovation people to go to when I have large projects? What are neighborhoods like? It will typically take me half a year to really get comfortable and get to know an area before I would start investing there. So I don't take these things lightly, right? You need to build up a strong team before you can confidently invest there and also let your investor follow you, right? So yeah, so right now we're very confident about DFW, starting to look outside, but we're being careful about it. Okay. Yeah, just moving on. And this is self-storage. This is self-storage that was actually a new construction. Okay, so self-storage is also something else I invest in. They tend to do really well during downturns as well. What happens in downturns is people downsize from their homes into small apartments, and they have all these extra furniture that they don't know what to do with, right? So they pack them into the self-storage units. And people moving from class A down to class B, same thing, right? In downturns, self-storages are full. Okay. And then, yeah, so this one was pretty cool. It was an empty warehouse, and self-storage is very easy to build. You put down 4 poles, you wrap the metal sheeting around, and you're done. Pretty much, you're done. There's no electrical, there's no plumbing, nothing to worry about. That also means that there's not much you can do to increase the value. Okay, there's not much you can do to increase the value of your investment. So self-storage is very stable, maybe 8%, sometimes 10% return, but not much upside, not much downside either, right? So I bought this. I invested in this as a new build, mainly because it's a little bit riskier, but much higher room for return. So right now, because of the risk, it is running about 1.5 years behind schedule. This is a historical building. It takes time to sell the historical credit. There's things that you can't break in a historical building, blah, blah, blah. But yeah. What I'm trying to say is all investment have risk. So make sure you understand them. And of the 12 deals that I invested in, I try to spread them out into different type of things, right? So I did blind funds, I did self-storage, I did senior living, I did you name it. I try to get as much exposure into different investment types as possible, so I can learn from the different sponsors, and I also can see what type of investments does well. Okay. I have not done an RV park. Yeah, that just wasn't one of my things, because RV park, mobile home parks are actually very similar to self-storage. Similar returns, similar risk profile. They also do very well during downturns, but usually just you're investing in the pad, not the home, not the actual mobile home. So yeah, wasn't as exciting. Okay. This is super weird. I invested in a plumbing company, but not your residential plumbing company. This is like commercial size, right? Big pipes, not small pipes. So this was probably my first syndication investment experience ever. And as it turns out, it was also the first time that group has ever tried to run a deal like this. Okay. So they did, the group I invested in, they did really good in the apartment stuff, but they did not know how to do this. Okay. So, the idea was, hey, you invest in this, we're going to increase business from 1 million to 1.8, and then we'll be able to return all the principal. So, the sponsors were all neurosurgeons. They were loaded. They had a lot of money and experience, but they didn't know how to run something like this, right? So we're selling this one at a huge loss. Okay, biggest problem was they didn't raise enough money upfront. So unlike apartments where you get paid every month, when you do service contracts, it takes 2 months to finish building this out, and then you bill them for invoice, which they don't pay until a month and a half later. So that means there was, right after they bought it, there was 3-month period where they were not getting any income, right? So they had no money to pay the plumbers, and those plumbers got mad and walked away, and the whole thing just fell apart, right? So yeah, that was not a good idea. So they did not know what they're doing. So, but I have tons and tons of stories like this because I invest in many different things. I talk with a bunch of other people, and that helps me, build a network of people that I can cross-check my ideas on and make sure I know what I'm investing in. And a little bit about like what happened, Texas, right? We all know about the Texas freeze that happened. So this is not my apartment. This one is one of our properties. It's a Class C property. So the Class C property did extremely well. We had electricity, heat, everything throughout. We only lost water for about a day, okay? And that was because the city shut it down. When the water was turned back on, we had a few pipes that burst, but damage was minimal. It got fixed within a day. One unit probably required $3,000 to fix, but nothing major. Okay. Meanwhile, in the Class A units, in the Class A apartments, right, the brand new ones that you see, those got hit extremely hard. Why? It's because the Class A apartments have these high pressure water sprinkler system, right, for the fireproof. And when those pipes burst, those water are extremely high pressure and they literally cut through drywalls, okay? And tremendous amount of water come out in very short amount of time. So Class A apartments that had water burst, we're talking about hundreds and thousands of water damage. Those got hit really, really hard. Whereas B and C, not so much. Within the portfolio, I think the worst hit was one building where they cannot find the turn-off switch, and and the other turnoff switch was actually frozen, so they had to shut down a valve that controlled 7 buildings, right? So 21 buildings out of 28 buildings, 21 buildings were actually down without water for like 2 days while they repaired the issue. That was probably the worst. Okay. The best one was the water fountain pipe broke. That was it. No unit had any impact, but the water fountain up front, yeah, the pipe burst, and who cares? It was ugly. We're gonna replace it anyway. So yeah. So yeah, it was good. But yeah, overall, that's my presentation about, this is what the apartment investing is like. As a passive, it's great. It doesn't interfere with your everyday job. You're getting much better return than in a bank, while still kind of protecting the downside, right? When the economy is not good. Okay. So Rita was asking for self-storage investment. Did I purchase land? No, for that one, it was actually a pre-existing warehouse that we purchased, and we just added the self-storage units to it. The nice thing about that is because it's an indoor unit, that means we can provide weather. It's temperature controlled, right? So if it is temperature controlled, then you can usually charge like $10 to $15 extra per unit. Yeah. So yeah, I know I cover a lot of stuff. I usually try to keep this short, but lots of good questions, and went way over time. But yeah, I'm more than happy to answer any other questions you guys have. Yeah, so feel free to email us, and so these are some of our acquisitions. As you can see, everybody just, Dallas-Fort Worth is awesome because it has one of the biggest and busiest airport across the United States. So yes, I will be sending out a copy of the presentation to everybody. And hopefully I can also get the recording for this. Yeah. Yep. Becky was asking me. So on these trips, on the recent trip, I actually had a couple of investors come with me on checking out on these deals. So we are bidding on some of these, but right now the pricing is just crazy. I don't know if I told you guys, but last year when COVID hits, there were a lot of large institutions that were getting ready to buy things on the cheap. Okay, so things like BlackRock, things like JP Morgan, they raised $5 billion funds. Okay, for an investor, telling everybody like, hey, now things are going to be on the cheap. We're going to go in and we're going to just buy up a bunch of them, right? So they got all their money ready. They're ready to buy last year during summer. But then multifamily held up so well, barely any impact, that they did not get the fire sale that they were expecting. Okay, so what ends up happening in the fall, in September, was they have $5 billion of investors' money with nothing to buy. Okay, and it was very embarrassing. The investors had the money with them for 6 months, and it's not making an income, right? So they were in desperation mode, and we're still seeing that. So they're buying up any large properties that they can get their hands on. Doesn't matter the price. Okay, so from like September all the way until now, we're just seeing outrageous prices being paid for these properties. Prices where, at the price that they bought, they're getting like 2% return on their money, right? But these large institutional buyers, they don't care. They just need to use up the money. They need to buy something. So we're still working through that. We're still looking through these kind of competition that doesn't care about returns, but we do. So yeah, we're continuing to bid, and we'll see if we can win something and then have something to offer people. But once again, if I'm not able to get a good return for people, I'd rather not buy it, right? So yeah, is that why all the large cap class? Yes. These blind funds also, on syndication scale, blind funds also, they raise a few, maybe close to like $50 million. They need a place to use them, right? So yeah, otherwise they have to return the investors' money, and they didn't make any money, right? So that looks bad. So they just have to buy something and stretch out their return timeline to be 10 years or something. So, but yes, when we do get a deal that makes sense, we'll definitely offer to the people that are part of our mailing list. So be sure that you sign up for the mailing list. I'll also send up another link, but if you go to our meetup page, the mailing list should be there as well. Almost hit 100. Okay. Yeah, so if you kind of go to like what we're about, on the bottom, here's a link for the link newsletter. Just click on that. It'll take you to a very brief questionnaire. Just tell us a little about yourself, and then you'll be added to the newsletter. I'll also post it in the chat just in case. My old buddy Terry wants to go drifting. Interesting. But yeah. Okay. All right. So this is a quick overview. Any one of these topics, I can spend another hour or two going into greater detail. I also try to invite people who are more professional than me. So in the past, we have invited lenders, the people who are very experienced in the self-directed IRA. I invited the VP of CBRE, property management companies, etc. So definitely stay tuned. This is the property management company that we use. It's called Wayner Multifamily. They operate 170 apartments in Dallas alone, managing about 27,000 units. So very experienced, and we operate on a large scale. And yeah, so the Godfather. I also invited my regional property managers to come give a talk about like how the apartments run. So yeah, definitely a lot of interesting content that we'll have on the meetups. Cool. Well, thanks everybody for your time. Feel free to text me or email me if you have any questions. Okay.
Thanks, Tony. It's awesome.
Yeah.
I'll talk to you again, but very good. I wish, I have some clients that live down the street from you.
Uh-huh.
I wish I could have got them invited into this.
Yeah, I mean, feel free to have them reach out. I love telling people, because I think most people aren't familiar with the concept, so I enjoy sharing. So yeah, I'm happy to do another session.
Cool, pretty awesome. Thank you.
Yeah. Okay. Great. Thanks, everybody. Have a good night.